Hello and welcome to Econoday Unplugged on Wednesday, the 20th November 2019. As ever, Mark Pender is across the water on the US East Coast, and I'm Jeremy Hawkins here in London, where the weather may be getting colder, but the election hostilities are certainly hotting up. We're in the midst of a slightly quieter period for economic indicators, and I guess it's politics, be it trade talks, a possible presidential impeachment, approaching general elections, and inevitably, if not exactly on the front burner at the moment, Brexit that's currently attracting investor attention. Still, look closely, and there's always the odd nugget or two of economic data that's worth keeping an eye on. And I guess on your side, Mark, the housing market is deserving of a mention this week.
Yes, it is. It definitely has pivoted higher. It seems to be pivoting higher over the last couple of months. On Tuesday, we had housing starts and permits, and they were much better than expected for permits. Starts came in about as expected, but what's interesting about both of them is that their averages are clearly pivoting higher. And so that looks to be a positive for residential investment in the fourth quarter. Remember that residential investment in the third quarter offered its first positive contribution to GDP since 2017. So it's been a long spell of contraction. Yeah. For housing. Mm-hmm.
Yeah, sure. On the starts, can you tell me, was it a broad-based increase, or was it just a regional, a particular area, or how did it pan out?
It's been broad-based. It's been centered in where you want it to be centered in, which is in the single-family category. They have the highest costs, and they give you the most punch for GDP. But multifamily houses, family homes were also up in October's data. So it was an overall very solid picture. We're going to get existing home sales tomorrow, and forecasters in our Econoday consensus here, I'm just calling it up now, are looking for a significant increase. That is, it's a 5.48 million annualized rate. That would be up from 5.38 in September. Which was a month where they did fall back, but this series too less than a new home sale. So we moved from permits to starts, and in new home sales have been pivoting very much higher. This is the new homes category. Now resales have been also pivoting upward, but at a much shallower rate. And assuming there's more turnover in the new home interest in buying new homes, there'll have to be more resales as people move into their new homes. So that's probably going to be a plus.
And is this the Fed? Is this lower interest rates doing what it's supposed to be doing?
Exactly. This is favorable interest mortgage rates, about 4% for conventional 30-year loans. That's where it's been holding. Mortgage banker data came out this morning. This is weekly activity from mortgage bankers, and their purchase index, which is the amount of purchase applications, has been humming along very nicely right now. And it's a 4% for conventional 30-year loans, roughly, where the rates are now very favorable. And of course, we have such high levels of employment. And even though wage gains aren't through the roof, but there's a lot of people with jobs, and that's helping families, in the housing sector. So it's this can help offset the weakness that we're seeing in manufacturing here in the U.S. So it's one of those outside factors. It's coming in from something that's been a slight drag to something now that can be a positive and may help overall fourth quarter GDP.
So do you think this is going to sort of spill over into, I see we have consumer sentiment figures on Friday. This pickup we've got in the housing market, do you think it's going to spill over into that?
Interesting question. It's not really a housing boom. It's
but a step in the right direction.
It's moving. Yeah, it's clearly moving upward. It had been flat to shallow to sinking a little bit. So it's now clearly pivoting higher, which for economic data and a quarter, month-to-month basis, that movement is a big positive. Now, overall, if you look at the levels, they're still very low. I mean, compared to where we were. We finally, in housing starts and permits, these levels are finally reaching the levels that we had in the 2007 subprime housing bubble. So it's taken 12 years to get back to where we were, and sales levels are also have also been subdued. That whole subprime thing pulled the housing sector pulled activity, pulled building, pulled buying forward for it. It's a super substantial amount of time, and it has led to subdued rates of growth in this economic cycle.
Okay, interesting stuff. Thanks for that. Okay, well, on my side of the world then, not often we can talk about good news from here, particularly out of the Eurozone, but at least as far as last week was concerned, against market expectations, we found out that Germany, at least provisionally, avoided recession. The flash third quarter GDP figures showed a minimal, it's got to be said, but at least it was up, a 0.1% quarterly gain in total output. Well, that's got to be put into context because we saw the second quarter decline revised to down 0.2% at a quarterly rate. So to all intents and purposes, the third quarter recovery, to the extent there was one, didn't actually fully reverse what happened in the previous period. But at least on a technical basis, it does mean that Germany avoided the recession, and perhaps that may be of some psychological value to the German consumer. In terms of where we go from here, well, the main data as far as European markets are concerned this week will be the November flash PMIs. They're due out on Friday. And as we all know, particularly as far as Europe's concerned anyway, they're very much one of the sort of the linchpins in determining what happens to investor sentiment. Now, focus for a long time now, as Mark was talking about the weakness in manufacturing on his side of the water, it's been a poor manufacturing sector which has been dominating the slowdown in the Eurozone and indeed UK economy we've had for the best part of this year now. And that's been very much typically the focus of investor attention. But I think now, because we're starting to see some concerns that spillover effects into the services side are becoming that much more prominent, it's going to be worthwhile keeping an eye in particular on what comes out of the services side of these PMIs, the flash PMIs for November, when we get them on Friday. I thought, one of the things which perhaps a lot of media didn't really pick up on, but when we had the October numbers, which we saw for the first time in almost 7 years, expectations for future activity in services actually turning negative. So, okay, it's only expectations rather than current, but it does suggest that service businesses now are starting to become that much more concerned about what's going to happen in the future.
So can I add something here? So this, I guess, reflects an overall dampening of the economy, probably pinpointed in global trade and its effect on manufacturing. And on that theme of a wider thing, can I ask about prices now? Prices have been subdued, but we had Canadian prices out this morning, and they're and they're doing, Canada's doing as well as anybody, but their prices right at the 1.9%, right for several months in a row now, right where the Bank of Canada wants it. Now for Europe, I've been noticing that the PPIs have been soft. We had German PPI. Can you touch on that today? And also, there's been repeated weakness I've been seeing in some of these reports in the intermediate sections. And what does that mean?
It is. I think that's right. It's clear when we're looking at producer price indices, as far as Europe's concerned anyway, we're talking about the manufacturing sector, so it's not including services. But nonetheless, the PPI, the producer price index, so the cost of goods as they leave the factory gates, it is seen as being a leading indicator of what's going to happen to overall consumer price inflation. Now, you touch upon Germany, which I think is a good call, because German developments at the moment are kind of symptomatic of what we're seeing across a fairly large chunk of the Eurozone. The October German PPI, then, that was down 0.2% on the month in October. It's been pretty well flat or down now for the best part of the last several years. The year-on-year rate is now running at 0.6%, and that's the lowest we've seen in a number of years. And it's not just for headline figures, which we know get biased down by volatile factors such as oil and the like. But if we exclude energy, we're now running down at just 0.3%. Which even by German standards is historically very soft. So I think almost wherever you look at prices in the Eurozone. We're talking about Germany here, but you can really use that as a kind of a benchmark for the rest of the Eurozone. Service sector prices are holding up rather better, but overall price pressures in the Eurozone currently are still extremely low. Of course, as mentioned, we get these purchasing manager surveys, the flash numbers for November out on Friday.
Mm-hmm.
People, as always, be looking at the price component of that. But the bottom line, it really just seems to me, is that whatever they indicate, they're going to simply confirm that Eurozone economic growth currently and probably over the next several months, if not quarters, simply isn't going to be strong enough to generate the inflationary pressures needed if the ECB is to get CPI, or HICP inflation as they call it over here, up towards this near 2% ECB target rate. So it's all sort of fits together in terms of sluggish growth equals weak inflation equals increasing pressure on the ECB to do yet more with policy.
Well, how much more do they have to get prices up? 1 percentage point in Europe?
Well, effectively, yes. I mean, in terms of the latest sets of figures we had, these were for October. The headline rate itself now is down to 0.7%. Now, I think, as we all know, so this is biased down by what's happening in the energy market at the moment. Although, of course, we have the risk that headline inflation being so low could influence inflationary expectations and perhaps wage demands the wrong way and second round effects. But the core numbers, the underlying inflation rate, as it has been, I think we've talked about on a number of occasions over the last 2 to 3 years now, is currently running just a tick over 1%. It really has completely flatlined, and the worry for the ECB must be that if growth doesn't start to pick up at some point, rather than underlying inflation going up, it's going to go down.
Well, it's also a question of goods specifically. There's with lack of trade, slowing trade, there's a buildup of goods, and and that it has a price effect. So and that has a dampening price effect. So it'd be difficult, I think, to ignite wholesale inflation. I'm not sure exactly how central banks can manage that specifically. If they're focused on the employment market and driving up labor, that could help wages, in turn help demand for goods, I guess. But it's kind of a difficult inflationary picture right now. In the U.S., we're going to get core prices next week, and there might be some improvement, but it's at least roughly around 2%, about 1.7, I think, in the last one. And they wanted to move higher, but it's not a big emergency, or it's not as important as in other spots.
No, certainly. I mean, you say low inflation is just becoming more and more of an issue globally. And it's, as you say, I think, when central banks have done as much as they have already in terms of interest rate cuts, if not, massive amounts of, balance sheet reflating, then you do wonder what else they can do. Quickly on the politics, I should mention, since unfortunately, as far as the UK is concerned, we do have an election coming up on December the 12th. So really do have all the parties now in full sort of pre-election swing. And I guess what we can say at the moment is in terms of what does it actually mean? Well, clearly we don't know who's going to win yet, but all the parties are really talking about, putting government spending through the roof. What appears to be the current theme currently is that although the Conservative Party have traditionally been seen as a party of sort of fiscal austerity, or at least fiscal discipline, they appear to be going more and more down the Labour route, whereby effectively they're going to start targeting government spending, excluding investment spending. So really, they're going to try to, both sides now, both Labour and the Conservatives, are talking about having some kind of small surplus target for the current budget deficit, so current spending less current taxation inflows, and effectively take the investment side off balance sheet, which means, of course, they can come out and meet perhaps their current spending target, but they can actually see in terms of actually overall public sector borrowing, if they're going to meet some of these targets or proposals they're talking about on spending on national health, on spending on schools, on infrastructure, then public sector borrowing in the UK, whoever wins this election is going to go through the roof. And
this is this a counter-cyclical or foreshadowing or trying to cover the seam of a Brexit on both?
To be honest, it's a fair question, I think. And to be honest, it's not really clear. I mean, I suppose I put my cynical electioneer's hat on and assume that it's a classic government stance at a time when all the parties are really worried about how the elections are going to go because of this great big Brexit unknown, the impact of that on voter intentions. No one really has got a clue about how this election is going to go, irrespective of what the opinion polls are going to say.
Well, the supporters of Brexit, do they see economic acceleration for the UK following this? I mean,
well, this is part of it, I think. I mean, in terms, if you listen to what the likes of the Bank of England have been saying, as we've talked about on a number of occasions, their central case scenario is we get this kind of a smooth Brexit, we get a trade deal with the European Union, as a result of which, as you say, we get some kind of significant boost to business sentiment, consumer sentiment, the housing market, economic activity in general picks up, and the Bank of England is duly forced to raise interest rates. So there's certainly that possibility. But of course, as we've also talked about in the past, we're not really sure what, say, shape or form Brexit's going to take, if indeed Brexit does actually happen. I think from the way the pound's currently trading, it would seem that as far as the FX traders are concerned, the idea of a no-deal Brexit has pretty well gone completely out the window. The pound is so strong, it really would seem to be discounting some kind of soft Brexit scenario. But in terms of the opinion polls, we've got to say, if you look at the polls at the moment, the Conservatives are running at around about 40%, Labour only about 29%. So we're talking.
What was the impact of any immediate impact of yesterday's debate?
That's easy. I can probably safely say to that, pretty well nothing, in a sense that weren't any big sort of knockout blows. It is more a case of both sides trying to expand on how whatever they're going to do is going to be best as far as the economy is concerned. But in terms of the way the financial markets have reacted, really, I think, well, the main media coverage over here was concentrating on the fact that the Conservatives decided to rename their press office Twitter account Fact Check UK during the middle of last night's TV debate, which has gone down like a lead balloon by most people since the Twitter account has got nothing whatsoever to do with fact checking. So that didn't go down too well. But otherwise, I think, no, it was a fairly, not necessarily friendly affair, but it's the kind of, it's a kind of typical leader versus prospective leader battle, which really didn't really give too many clues about what's going to go on.
So are we heading to a 50-50 kind of a vote? The split between the different parties?
It could be. As I mentioned, at the moment, if you take the opinion polls at face value, the Conservatives are at 40% and Labour at 29%. Now, that gives the Conservatives, more than a 10 percentage point lead over Labour, which, if it was evenly spread across the country, would be enough to give the Conservatives an absolute majority in Parliament. However, there is certainly sort of themes going through some of these intentions which suggest that as big a lead as the Conservatives have, it's probably more to do with more voters in those seats which they were expected to win anyway, voting Tory than previously. So in other words, they're gaining ground in seats they're expected to win anyway, so it doesn't make any difference in terms of the other seats, the ones which should actually need to win off Labour and the other opposition parties. So in terms of where we go from here, it really is anyone's guess, which I think makes it extremely interesting for financial markets, because they still don't really know how to react, bar the fact, as I mentioned earlier, they are assuming that it's going to be some kind of relatively soft Brexit. And without just trying to drag on too much about politics, traditionally over here, a Conservative government is simply taken, is well received by the pound and well received by financial markets. However, in this case, if we were to see the Conservatives, let's say, get a really substantial Commons majority, that would allow then Boris Johnson to do effectively whatever he wants with his Brexit deal. So he's got a deal already agreed with the EU. He could force that through Parliament, but recall that this is just the Brexit deal, the withdrawal deal. What happens after that will be negotiation about what happens about UK trade with the EU, and that will have to be sorted over the course of 2020. Now, some of the murmurs which are coming out of the Conservative Party suggest that he may not be particularly interested in securing trade deals per se with the EU. He's going to want to look elsewhere. And that's when all of a sudden this idea of perhaps a harder Brexit the markets are currently discounting starts coming back to the fore again. So the politics of Brexit have got a long way to go yet.
I have two questions. One is how explain a 40% share being an absolute majority in Parliament.
Well, 40% is talking about literally the opinion pollsters going around the country and asking, right, who are you going to vote for? Is it Labour? Is it Conservatives? Is it the Greens? Is it the Liberal Democrats, etc., etc.?
Total.
And on the basis of those polls, on average, the Conservatives got about 40% of the national vote. Labour have got 29%, and so on.
So how does that break into seats?
Well, this is the problem, because you can't actually necessarily derive the seat total from the simple share of the vote. We have individual seats where people will vote will in one particular in one particular county may not be the same kind of matters we get somewhere else. As I recall, I think in one particular Scottish constituency during the last election, that seat was won by just 2 votes. Another seat, if you win it comfortably, you could win it, let's say, by 10,000 votes. So percentages really only give you a very broad indication of what might happen.
So you could have 40% of the vote and 50% of the seats.
Yeah, exactly that. Yeah, if you won all the right seats and you won everything really closely, yes, you could do.
Now, one other question is your National Health Service and U.S. prescription companies. How is this playing, or what are the issues right now that's in the election?
Well, the issues here at the moment, we have the National Health Service, which means that any UK resident is entitled to 3 health services as part and parcel of the government organisation. Now, depending upon age, you do have to pay for prescriptions and so on. But anyone, you can go along to see your GP, you can be put into hospital, and you will receive free service. If Brexit happens and we decide to, let's say, move away from some of the pharmaceutical deals we've got the rest of the EU and move across to the States, the cost of importing medicines and pharmaceutical products from the US will be significantly more than we have via our various trade arrangements we have at the moment with the European Union. And that then would raise the chances that we'll see cost of medicine going up sharply. We'd start to see probably some kind of inroads into the sort of the privatization of a national health service as well, which is currently a pure public institution. And then again, it raises the potential then for higher prices. And that's one of the big issues which Labour are very much touting at the moment, saying this is what Conservatives are going to do. And Conservatives say, no, the NHS will not be touched. But politically, hot potato. Right. OK, well, I guess that's enough of the politics. Let me quickly round off with just some of the other bits and pieces from last week, just mentioned in terms of global economy. And most of it was pretty poor. Third quarter GDP out of Japan, that was up just 0.1% on a quarter-on-quarter basis, which is miserable, less than expected. And the worrying aspect there is that we saw a pretty decent bounce in consumption, which was to be anticipated because we saw consumption tax being hiked at the beginning of October time. So very probably consumption is going to go negative in the fourth quarter, and that could well lead to negative Japanese fourth quarter GDP growth. So something to keep an eye on there. China, I think last week we talked about the industrial production retail sales figures coming out. Well, both of those undershot expectations. Sales in particular the weakest in 6 months. So again, some fresh signs that perhaps China's starting to slow a little bit as well. And out of the RBNZ, Reserve Bank of New Zealand last week, although there's no change in interest rates, the bank now has come out and indicated it's going to publish a, quote, clear theoretical framework of alternative policy options early next year.
Who's this again?
This is the Reserve Bank of New Zealand. So they got to the stage now whereby they're a bit like the RBA in Australia. They're reluctant to see interest rates go negative, and they're looking into, well, basically, what else can we do if we need to loosen policy further?
Their policy rate, I think, is at 1%, and Australia's at 0.75.
Yeah, that's right.
So they're running out of room,
Exactly. And I think they didn't want to do quantitative easing. The RBA said they don't want to do quantitative easing, but both central banks, by the look of it now, are starting to, well, look, if push comes to shove, we may have to do it. So it may be back to a world of quantitative easing again. I mean, whether or not what the Fed is doing is quantitative easing or not, the balance sheet's going up. The ECB is back on quantitative easing again. So.
Hey, as long as no one complains or they accept it, I mean, it's good for the markets, right? So,
well, but the danger is it's good for the markets, but I suppose increasingly are these markets just being bolstered by a tidal wave of money rather than what's actually going on in the real economy.
It's the unreal economy now. It's the new economy. How you like that?
It is. That'll do, and I think that sounds a happy note, a new economy on which to end. Okay, so let's finish it up there then. From Mark and myself, as always, thanks for listening. We'll be taking a break next week, but Econoday's global economic calendar most definitely won't. So do check there to keep up to date with all the key economic indicators and market events. And we'll be back in a couple of weeks. Bye for now.